let's talk about some previews coming in, and this one from the cement sector. How is that likely to perform in the first quarter? Nigel is standing by at the big wall to tell us more in our special Quarter Tak. Nigel.
Well, the key factors to watch for the cement industry in the past quarter include strong volumes, lower cost, as well as flattish prices. Let's address them piece by piece. The volume growth is expected to be strong as the cement demand grew significantly at mid-teens on a year-on-year basis. That was mainly driven by government infrastructure projects as well as stable housing demand. Now, the energy costs, they're expecting to decline partially in the first quarter, leading to an overall decline in the cost on a quarter-to-quarter basis. Jefferies predicts a 100 rupees decline in the overall cost per ton. Now, cement prices a little bit weakish in the first quarter. That's on a quarter-to-quarter basis, particularly in the eastern and the northern regions, where prices were stable in the southern region. Now, Jefferies expects a 0.5% to 2% decline in realizations on a quarter-to-quarter basis. The result of the above three factors is that the EBITDA per ton is likely to improve slightly on a quarter-to-quarter basis. Now, spot energy costs, they have declined further in quarter one, but benefits will reflect only in the second quarter. Jefferies predicts around a 50 rupees per ton improvement on a sequential basis. We have a couple of smaller cement companies who have already reported their numbers, and there are signs of some kind of margin improvement. Jefferies has listed out potential out and underperformers for the first quarter. ACC and Ambuja, they say, are likely to report better year-on-year growth. That's because of a low base. In the mid-cap space, they are talking about Ramco as well as Dalmia Bharat that are expected to have strong volume growth on a year-to-year basis. However, UltraTech Cement's quarter one EBITDA growth appears a little bit lower, but that's because of a very strong showing in the same quarter last year. There will also be some improvement in the profitability in quarter one FY24, but the full benefit of lower costs will reflect only in the second half of the year. Well, let's wind this down with a valuation snapshot then of all those companies on an EV upon EBITDA basis as well as an EB per ton basis. So that's about a rough valuation check. Well, to discuss more about this and discuss it in a little bit more detail, we're joined by Rajesh Ravi, who's a research analyst at HDFC Securities, who joins us on the show. Hi, Rajesh. Thanks so much for joining in. Well, could you fill us in with your estimates? What kind of volume growth are you factoring in first for the industry, as well as a rough EBITDA per ton improvement in the past quarter?
Hi, good morning, Nigel. For the industry, we are factoring in sequential decline of 3%, which implies around 16% year-on-year volume growth. Now, this is one of the strongest volume growth quarters, even on a decent base of last year. So volume growth last 3-4 quarters have been close to 8 to 10%, and this quarter it has further accelerated. And as you rightly pointed out, the growth is being driven by pickup, strong momentum in the government projects, and even the housing projects. Housing execution remains healthy. So overall, Q1 numbers are very strong on volumes front. And pricing, it was expected that this quarter and even in the last quarter, there was no price hikes. And given that the fuel prices are cooling off, it was given that the industry will look forward to pass on some of the benefits. And this is where we are looking at close to 1.5% realization decline for the industry as a whole. And that despite this realization decline, we are expecting margins to be flattish to slight. Yeah.
All right, Rajesh, I missed that number. EBITDA per ton you're expecting for the industry improvement in quarter one versus quarter four. That will be how much? And for the second half of the year, what kind of an improvement per ton you're working with as of now? Things can change, but as of now, what are you working with?
So Q1, we are working with around 900 rupees EBITDA per ton, which is around 20 to 30 rupees improvement quarter on quarter. So sort of flattish number. However, on a year-on-year basis, it is still down 70 rupees, which we believe would be taken care of in the subsequent quarters. In Q2, we believe, while there will be a further cool down in the costs, even realizations will come off, which is a seasonal phenomena. So between Q1 and Q2, chances are that we may see a slight dip in margins, and thereafter, in the second half, the margins will pick up.
All right. And which of the companies do you think will outperform the industry when it comes to volume growth? And which are the ones you think will be the cost leaders here, best margins?
Right. So as against industry growth of 16%, we are Ultratech has already reported 20% volume growth.
Yeah.
And we expect Ramco to deliver 30% odd volume growth. Even ACC and Ambuja, we are factoring in north of 15% volume growth. Same for Dalmia, closer to a 15% volume growth. And JK Cement, which is ramping up its Panna capacities, they would also be delivering 30%. So Panna, Ramco, Ultratech, and the Rani Group companies, they should be reporting more than 15% volume growth in this quarter.
What about Sanghi Industries?
Northeast Stars.
Rajesh, what about Sanghi
while
Industries?
it is not in a
Yeah.
Sanghi, while it is not in a under our active coverage, the company has been facing pressure in terms of its volume offtake. So, given that overall demand traction is good in the Gujarat markets, if it is able to deliver good volumes, that is a positive for the company. But that is it. They are still to pick up and cover the lost ground in terms of the falling utilizations year on year.
No, actually, Rajesh, it doesn't matter what they do, right? Because the inorganic growth is what's taken center stage. And in the last 5-6 days, I think the stock has moved up 20% approximately in the last 10 days or so. So the street clearly believes something's in the offing.
Right.
Who you think it'll be the best fit for, and what kind of EV per ton would you assign to the company?
So, who would, for whom this asset could be a strategic one? Obviously, some big player only would be able to make sense of acquiring this asset, because for them, this coming up with a port infrastructure and better easy access to even the western and the southern coasts, a bigger company can absorb the costs, from day one itself. Any smaller names, obviously, any smaller name or a sub-regional, 2-3 regional player may, players operating out of 2 to 3 regions, they may not make a good fit for those companies. So bigger companies obviously are better off, if at all it goes to a company like Adani Cement, Ambuja acquiring it, or maybe, Dalmia looking forward to it in some time future. Again, that will depend upon the valuations at which these assets are acquired. Because as any bigger company acquiring Sanghi, they would only want to acquire this for the asset. The brand obviously will be of the bigger guys. So they may not want to pay a premium more than $100 for sure.
Got it. Okay, thanks a lot for that, Rajesh. Appreciate you joining in and giving us all those details. Well, on that note, though, we'll wrap up on this session of Chartbusters. You stay with us. Trading Hour comes up next.